we are going to talk about other taxes, payments, and refundable credits. And so you're going to be able to find most of this in your tab H in the 4012. And so again, you will be able to find the recording of this training. It will be on our YouTube page. If you go to YouTube and type in Dallas Community Tax Centers, you should see this up there on the middle of next week. But what we'll do, everyone that has registered for this webinar or any of our other webinars, we can send you out a email blast and just letting you know that this information is available for access on our YouTube. So stay tuned for that. So our other taxes, payments, and credits on our tab H. So these other taxes, so this is different from our income tax that we have to figure with the tax table or the tax computation worksheet. This is in addition to that federal tax. So these other taxes, it's possible it could be self-employment tax, Social Security and Medicare taxes on tip income, additional taxes on IRAs and other qualified retirement plans, repayment of the first-time homebuyer credit, and there's one not listed. It could be related to the premium tax credit related to the marketplace health insurance. So these amounts are usually calculated on their own form or schedule, and they're entered on Schedule 2 of the Form 1040. So these taxes are added after the non-refundable credits, which we just talked about, are calculated on here. So non-refundable credits, they do not reduce other taxes. So this gets added onto the tax liability if there's any. If the non-refundable credits have zeroed out the tax liability, well, now we have these other taxes, this amount listed on the tax return now. So the first one we're going to talk about is the self-employment tax. This is the Social Security and Medicare taxes from individuals, again, who are self-employed, also known as sole proprietors. And so they are considered the employee and the employer for themselves. So they're responsible for the employee and employer portion of the Social Security and Medicare tax. So we've talked about an adjustment where half of this self-employment tax they're able to take as an adjustment that reduces their total income. But on the other taxes side, you're going to see this full amount notated again as other taxes. So as W-2 individuals or people from retirement, they may have, as they receive their payments, they have federal taxes and Social Security and Medicare tax being withheld, but that is not the case for self-employed individuals. They receive their gross income minus without any taxes being withheld, so they're responsible for that on the tax return. And we'll kind of talk about later how there's some ways that they can, reduce some of these liabilities or ways to help. They won't have to be paying this lump sum amount when they file their taxes. So some precautions that they can do. So the good thing about it is once we have entered in the business income, so that was what we talked about on yesterday. Once we have entered in the self-employment business income and the expenses, TaxSlayer will then calculate the self-employment tax for us. So we're not having to worry about doing that computation. It also takes care of the adjustment for us. So it's just notating where that is, and that is on the Schedule SE where it will calculate this tax. And then it rolls it over to that Schedule 2, and then also rolling over to the Form 1040 page 2. So this one also, this provision came with the COVID provisions. So this started in 2020. So with those self-employed individuals, if they had self-employment tax and they owed on their tax return, they were able to defer part of their self-employment tax where it would be due December 31st, 2021, and then the other half December 31st, 2022 on here. I would say that this is probably not the case for most of our tax clients. I don't recall seeing this at our site where we had our other sites where we had our self-employed individuals defer any of their self-employment tax. Also, again, this would mean that they would have had a balance due. So if there are credits that offset their self-employment tax, then they were not eligible for this self-employment tax deferral. So if there are any questions that arise about this, then you can definitely direct it to the site coordinator. So then we have our IRAs and qualified retirement plans. So when we talked about the 1099-R, definitely remembering that box 7 on the 1099-R is very special and very important to us because that determines the tax treatment of the taxable amount that's listed in on box 2 on the 1099-R. So this is related to those individuals that have a code 1 in box 7 of that 1099-R. And so that means that there is no exception that applies. It is a early withdrawal from their retirement plan based on they have not reached the age of 59 and a half. It was not rolled over into another qualified plan or IRA. So there's no exception, and they are subject to the 10% penalty of distribution. So this other tax will take their distribution amount, their taxable amount that they received, and multiplying it by 10%, and that gets added on the tax return. Now, some people say, well, I've already told my employer or the financial institution that provided the distribution for the 1099-R, I've already told them to withhold taxes. Now, some of those companies, they have a mandatory federal tax withholding of 20%. That's just to help with your taxes because that is additional income that you are reporting, but that does not take care of the 10% penalty. So I just like to let individuals know that is a 10% tax return penalty that gets reflected on the tax return. And hopefully that 20% that was withheld in federal taxes just helps offset that additional income that has been reported. So when we go into those, we talk about the penalties. Now, there may be certain exceptions that were not noted on the 1099-R that may apply to the individual as to maybe will relieve them from that 10% tax return penalty. And so you can see there's about 1 through 12 exceptions on there that may relieve individuals from their penalty. Number 1, qualified retirement distributions. If you separated from service in or after the age you reach 55. Just kind of going through those, you can be number 3, distributions due to total and permanent disability, distributions made on or after death. They could be IRA, number 7, IRA distributions made to unemployed individuals for health insurance premiums. Number 8, IRA distributions up to the amount you paid for qualified higher education expenses during the year. And IRA distributions, number 9, made for the purchase of a first home up to $10,000 per taxpayer and paid within 120 days of distribution. So as you can see, you can go through these, and typically what I like to do if I notice that a tax client has received a distribution early, I will then just ask them why or what prompted them to pull from their retirement IRA account. And then based upon their explanation, the reasoning, then I will see if any of these exceptions apply and if I'm then able to apply it to the tax return on there. So these are some exceptions where individuals may not be subject to that 10% tax return penalty. And pay close attention, you will see that some of them on there apply to just 401k, maybe pension plans, or some just apply to IRAs only on there. So these exceptions go based upon, again, 401k, pension plan, IRA. And so where do we need to go and enter this in if there is an exception? Because once we enter in the 1099-R on the income side and it has code 1, well, TaxSlayer already picks up that code 1 and automatically will apply that 10% penalty to the tax return. It's already going to fill it in on the other taxes on the schedule for us. But if there is an exception that applies, then we need to go into the TaxSlayer and go to where it has the other taxes section. And we're going to look for the form 5329. And when we go to that, we're going to see part 1, additional tax on early distributions. We're going to select who that form belongs to. And then in most instances, we're going to see that second box, early distributions that are not subject to the 10% tax. So we're going to fill in the amount of the distribution that they receive that there is an exception that applies for it. So we're going to input that amount that is not subject to that 10% penalty. And then right below that, from the drop down box, it says select the reason for exemption. And from there, we will select why they qualify for an exemption. So pay close attention to this because this is part of that advanced scenario 8 that we are working on. So another tax we have, other taxes, is HSAs. These are those health savings accounts. So we talked about that in the adjustment section. So if a taxpayer's spouse has an HSA and they make contributions, then they are able to, contributions outside of listed on their W-2, contributions, they are able to make an adjustment, so deduct that contribution from their total income listed on the tax return on there. And so the HSAs, these are funds that have been set aside used for qualified medical expenses. Now, if they are not used for qualified medical expenses, then that means the HSA distribution for that year, it becomes income and it is subject to a 20% tax. So once again, on that adjustment side, once we put in the contributions and the distribution, if an individual received a distribution for that year, it will then ask us of the distribution what amount was used for medical purposes. And if there is a difference or we're unable to put anything in the amount used for medical purposes, it will move that distribution amount towards income, and then TaxSlayer will calculate that 20% tax penalty for us. And as you can see below, there are exceptions. If the individual who has the individual who owns the HSA account, if they have passed, if they have become disabled, or if they have reached the age of 65, they are not subject to the 20% tax. And so then we go to the home buyer credit. So this is other taxes. So if individuals receive the first time home buyer credit, this was an incentive back in 2008. then generally they must repay the credit over a 15-year period in 15 equal installments. And this started back in 2010. So if the home ceases to be the taxpayer's main home before the 15-year period is up, the taxpayer must repay all remaining annual installments on there. So again, this is only related to those individuals that purchased their home in 2008 and took advantage of the first-time home buyer credit. And so that credit was up to $7,500. So they're paying a portion over time. So this could be the taxpayer and our spouse on that tax return. This produces the form 5405. And if an individual cannot remember what their credit amount is, hopefully we can look at their prior year return if they brought one in, or we can also go to the irs.gov website and type in first-time homebuyer credit. And if they allow us to, we can look up the amount that has already been repaid and the outstanding amount, the remaining amount that is due. So again, it says home ceases to be the taxpayer's main home before the 15 period is up, then they're repaying. So that's kind of like that example that we talked about on those capital gains or losses, the sale of a main home. If the first-time home buyer credit is related to that, is part of that, then whatever balance is left on the credit that is left to be repaid, that then has to be repaid in that tax year. So if it's $2,000 an installment, the remaining installment balance that is left, that will have to be paid in the 2021 on the 2021 tax return. So the next one that we have that's part of some additional other taxes is if it's related to the marketplace. This is the excess advance premium tax credit repayment. So if someone on the return had health insurance for any time in 2021 through the marketplace, they will receive a Form 1095A. So if advance payments of the premium tax credit were made for coverage of the taxpayer or dependent, anyone listed on the tax return, then we have to complete Form 8962. And so what results from this credit repayment is if their excess, the advance premium tax credit, if those advance premiums are greater, if the income is greater than what was reported to the marketplace. So what determines the premium or the assistance, the subsidy that individual receives is they're reporting their income or what they plan to earn for the year to the marketplace on there. And so if they actually receive like a raise, their income increases, they work another job, have another side job added, all of that income determines what their subsidies should be. So this advanced premium tax, this excess premium tax credit means they received a subsidy greater than what they should have. And so they're going to have to pay some of that subsidy back. And you can see in the chart below, it has a recap for that amount. So you can see for individuals, their income is under the 200% and they're filing as single. If their subsidy is that they need to repay back is $500, it's actually going to be capped at $325. As well as taxpayers using other filing statuses, you see that it is capped at $650. So then I like to remind taxpayers that as your income changes or fluctuates throughout the year, you definitely have to reach out and call the marketplace to update them with that information. So for the 2020 tax year provisions, this was excluded. They took this off of the tax return, but it is back for the 2021 tax year. And so also I wanted to go and mention about the first-time home buyer credit, that is found, that is a question that is listed on the intake sheet for our tax clients to answer. If they say no and they actually have to repay the first time home buyer credit, when we submit the tax return, we will get a reject code on there, and we will have to get that fixed and corrected before we can resubmit the tax return. So those are majority of the other taxes that we interact with on there. And so again, those other taxes add to the federal the tax liability that is already listed on the return on there. So this will increase the amount due what a person will have to pay. Now we go and we talk about payments. So our federal income tax system is designed as a pay-as-you-go system. So this means that taxes paid as income is earned or received during the year and is referred to as withholding credit. So for employees or people that are receiving retirement, or depending on the amount of gambling winnings that an individual has made, there will be federal tax withholdings. So for those W-2 individuals, typically when you start your job, if you're starting a new job, you have a W-4 that you have to complete. On there, and you have to let them know, are you single, married, are you maybe married but want to withhold at a single rate? Do you have any dependents that you're going to claim on the tax return? And so based on how you answer that W-4 determines how the amount of federal taxes that is withheld from each paycheck. The same thing from the 1099-R, completing a W-4 to determine the federal taxes withheld, as well as the gambling winnings. I know once it reaches the winnings reach a certain threshold, there is a requirement to have federal taxes withheld, or there are some options where you can choose if you would like to have federal taxes withheld or not. So these are the federal taxes or withheld are like the prepayment into the withholding. So when you file your tax return, you'll then see on the W-2, box 2, it shows those federal taxes withheld. So then that is helping offset that federal tax liability if there is any. And so once we've entered that information into TaxSlayer, we've already entered in those source documents. So we've already entered in a lot of those federal tax, that federal tax withheld, those payments. So many employers have income from self-employment, dividends, interest, capital gains, rent, and royalties. So the pay-as-you-go system also applies to this income. If the tax due on this income exceeds certain limits, estimated tax must be paid quarterly by the taxpayer. If the estimated tax payments are not paid when they are required, a penalty could be imposed. So this is what we like to mention to our self-employed individuals on there, that they would need to establish and make estimated tax payments. And so they are able to use their prior year tax information to determine what those quarterly amounts are. So when we're preparing the tax returns for this year, we're inputting their 2021 information. And through the conversation with our self-employed individuals, we let them know, hey, instead of having this tax bill of $4,000, why don't you do estimated tax payments? That means so if you make those estimated tax payments, you're not subject to a penalty, and you're not being hit with a big tax bill during the tax year. You can make these in small payments, so they're kind of considered like installment payments. And so what we would do, they're like, oh yes, tell me more about this estimated tax payment. In TaxSlayer, in the payments section, we can pre-print the estimated tax vouchers for the 2022 tax year. So for those $4,000 that $4,000 tax liability, it's going to print those estimated tax payments and it's going to print 4 of them, and they're going to have $1,000 each. It's going to let them know the dates that they would need to send those payments in, provide them with the IRS address. And so then we'll definitely remind them, if they make those estimated payments, to bring those receipts in so that we can then apply that to their 2022 tax return. So this is also for dividends and interest and capital gains, again, rent and royalties on there, because federal taxes withheld is it's not typically withheld from these income items. So it will be up to the taxpayer, once they receive this income, to make those estimated tax payments. So taxpayers who overpay their income taxes in 1 year can apply all or part of their overpayment to the next year's estimated tax by indicating the amount they want to apply. So we may have some individuals, again, they're self-employed, and they did do estimated tax payments, and they paid in more than what they needed to. So we prepare their tax return, and it shows that they're getting a $500 refund. Well, they're still self-employed, and they know, okay, I'm still working for the 2022 tax year, so why can I just roll that $500 over to the 2022 tax year? Of course they can. So we can then ask them, of the $500, what amount would they like to roll over? If they want to do the entire $500, we can indicate that on the tax return. Or if they want, let's say, maybe $400, we can indicate that in tax layer as well. And then that means the additional $100 they will receive as a refund to themselves. So $400 goes as an estimated tax payment, and then $100 will be issued to them as a refund. So there are some options in tax layer that we can assist with those individuals, or for those that have a refund, they can apply it to the next year's tax return. Now, some individuals, we know that this year's taxes, we have until April the 18th to file. Well, actually, we have April the 18th to pay our taxes on there. But then we have, again, those self-employed individuals, or some people, they just may have a lot going on that they cannot make this April 18th deadline. Well, what the IRS has is they have an automatic 6-month extension of time to file. So those individuals will have to submit a form 4868. This is an application for automatic extension of time to file. And just pay attention to that verbiage. It says extension of time to file, not time to pay on there. So this is a small one-sheet paper with just basic information. It will require the taxpayer's social and spouse social if married, filing jointly, their name and their address. They can estimate their tax liability and send this in. We don't do this a lot at our sites because we actually have a lot of clients coming in on the last day to file tax returns. So most of our sites, we typically will have this form already pre-printed for any tax clients to come by. They can pick this up and fill it out very quickly and take it to the post office on there. So this gives them time to file. It extends their time until October the 15th. And again, this is only an extension to file a tax return, not to make payments. Payments are due by April 18th. And if payment has not been made by April the 18th, there is interest and penalties that will be added onto the balance. So how does this look in TaxSlayer? So when we go in and we go to under the federal and payments and estimates section, we will see what I have highlighted. So I have the federal estimated tax payments. That section is highlighted. So if someone has made estimated tax payments already for the 2021 tax year, you'll see that the first line is where we will click to go to enter in those estimated tax payments. Then if they have apply overpayment to next year's, that is if we've completed the tax return and determined that there is a refund. So they want that refund for 2021. They want it applied to 2022. We're then able to click that button, and then whatever amount they want to be as an estimated tax payment for the next year, we can do that as well. This is very not common, but we may have some individuals, maybe they came on the last day or that last week to get their taxes prepared, and we were close to finishing the tax return, and we've went through the intake, but all of a sudden they just remember, oh, I have one more crucial form. So for whatever reason, we're not able to complete that tax return. And so they're like, well, I want to go ahead and do an extension. But with that extension, I want to make a payment on there. And so that last line, that's where we would be able to go and do amount paid with an extension on there. And because we've already started their return, we could submit that electronically if we needed to. And then right above that, the amount paid for extension, you see the vouchers for the estimated tax payments. So that's where we would go using the information that we have input in the tax system to produce and print out the 2021 estimated tax vouchers along with a copy of their tax return. So that will then add that sheet along with the return. So we've talked about other payments. So we're going to go into refundable credits. So this one is the additional child tax credit on there. And so again, like we talked about with these non-refundable credits, there are some new provisions that are out with some of these credits. And so we're just trying to also see with those new provisions how those would look like on the tax return. So some of this could be slightly different. So with the additional child tax credit, so these are for taxpayers who cannot claim the refundable or possibly they may not qualify. They were unable to check the box on the Schedule 8812, indicating that they or their spouse, if married, filing jointly, have a principal place in the U.S. for more than half the year, or that they are a bona fide resident of Puerto Rico, so we don't have to worry about that, may be eligible to claim the additional child tax credit if they meet the following conditions. Taxpayers with more than $2,500 of taxable earned income may be eligible for the additional child tax credit if they have at least one qualifying child. Taxpayers with 3 or more children may also be eligible for the additional child tax credit regardless of their income, and is limited to the $1,400 per child. So we do know that the child tax credit now is a refundable and non-refundable component. So just trying to figure out how that looks on the tax return, but there is also this additional child tax credit component still on the tax return. So moving on to one of the biggest refundable credits, it is the earned income credit. And so this also had some major changes for this tax year as well. So the earned income credit is a refundable tax credit for most people who work but do not earn high incomes. The purpose of the earned income credit is to reduce the tax burden and supplement wages of working families whose earnings are less than the maximums for their filing status. Eligible taxpayers can receive a refund with this credit even if they have no filing requirement, owe no tax, and had no income tax withheld. All taxpayers and dependents must have valid Social Security numbers by the due date of the return, including extensions to claim the credit. So going back to our day one topic on who must file and who should file, that very last chart that we talked about for who should file could be some of these earned income individuals. They do not have a filing requirement, did not have federal income tax withheld, but they did have some earned income, some compensation, W-2, self-employment income. So we would still recommend that they file a tax return if they to qualify for the earned income credit. And again, as you can see, everyone listed on the return must have a valid Social Security number by the due date of the return. So that's either April the 18th, or if they file an extension, October 15th to qualify for the earned income credit. So hence the name earned income credit. Individuals listed, they have to have earned income to qualify for the credit. So we're just going to focus on that first column. So that is wages, salaries, tips. It could be union strike benefits. It could be that taxable long-term disability benefit. So that's that 1099-R with the box 7, code 3. Net earnings from self-employment income, gross income of a statutory employee, non-taxable combat pay election. So these are our military individuals. That non-employee compensation, that is still those self-employed individuals on there. So this would be earned income. They would have to have at least one of these listed on the tax return in order to be eligible to qualify for the earned income credit. Now, this is something that you all will want to look at on the 4012 page I-2, because this breaks down the parts for individuals to qualify for the earned income credit. And you can see part A. The first column, it has rules for everyone. So you'll see again, everyone must have a valid social. The social has to be valid for employment to qualify. The filing status cannot be married filing separately unless you meet an exception. And so pretty much that married filing separate exception would be that, maybe the spouses lived apart for the last 6 months and therefore qualifying to be single or head of household, qualifying for another filing status. Must be a U.S. citizen or resident alien for the entire year. Cannot file Form 2555 related to foreign earned income. Investment income must be $10,000 or less. That's a big change from prior tax years. And cannot be a qualifying child of another person. So those are the rules for everyone to start to work the way to see again if you're still going to qualify. So then part B is rules if you have a qualifying child. So the child must meet the relationship, age, residency, joint return test, but not the support test. The child doesn't have to be your dependent. So this is kind of going back to those for that qualifying child. On there, we've talked about, again, that relationship, age, and dependency when we talked about those dependents on the first day. The qualifying child cannot be used by more than one person to claim the EIC. And then the taxpayer cannot be, again, a qualifying child of another person. So this is if you have a qualifying child. So individual, if they have at least one qualifying child meeting these requirements, And then we'll see that it may be some individuals that don't have a child at all, so though themselves, they may qualify for the earned income credit. A big change is must be at least 19 years old. So in prior years, this was 25 to 65. Under the age of 65, but over 25 to qualify for the earned income credit and not having a qualifying child. So they have reduced the age requirement on this. Cannot be a dependent of another person, lives in the U.S. for more than half the year, and again, cannot be the qualifying child of another person. So if someone meets those qualifications, then they have to meet the earned income and AGI limitations. So we're looking at their earned income that they've made for the year, as well as their adjusted gross income. And if it is less than the amounts in Part D, then they will qualify for the earned income credit. And as you can see, as a person is married, filing jointly, and have in their qualifying children, the number of qualifying children that they have, as it starts to increase, the earned income and AGI limitations will increase. So it will have to be less than these earned income AGI limitations to qualify for the earned income credit. So with a lot of these credits that we have talked about, we definitely want to, so first, we're going back, the earned income credit, taxpayers are not able to file an amended return. So once a tax return has been filed, again, with those individuals, so everyone on the return has to have a valid social. There cannot be an I-10 listed on the tax return for to receive the earned income credit. Even if an individual goes from an I-10 to a social, they cannot go back and amend that prior tax return. Possibly they may be able to do an extension if they're going to go from I-10 to a social, but not amending a tax return. And we'll talk about amending tax returns shortly. So for these refundable credits, on there, the IRS will not start issuing refunds before mid-February. So typically these individuals, they'll probably start seeing their refunds late February. This was passed a few years ago. So anyone that has any of these credits listed on their tax return, the IRS will start focusing and processing those mid-February. So the earned income credit, the child tax credit, the additional child tax credit, and the American Opportunity Credit. So they can start receiving their refunds again. It will be late February. The IRS has delayed or set a later date of when they will start processing these tax returns. Now, also related to these credits, some individuals may have a disallowance for these credits. And so if they have been disallowed in a prior year to claim these credits, they may have to attach a form 8862 in order to get to receive that credit in the next tax year. So this form 8862, it says information to claim certain credits after disallowance must be completed for any taxpayer whose earned income credit, credit for other dependents, the child tax credit, the additional child tax credit, or the American Opportunity Credit was previously reduced or disallowed. The taxpayer should have received a letter stating that they would have to complete the 8862. So if there is a place on our intake sheet, I believe it is part 5 in those life events, where it will ask the tax client, if one of their credits have been denied in the past. And so, in most cases and issues, I've noticed that people don't really understand that question. And so, if the Form 8862, if it has to be completed, typically I've noticed once the return has come back from the IRS, and we have to attach that on the form. And so, we definitely just want to make sure with these credits, because these are refundable credits, and making sure that the taxpayer is properly able to claim. We've done our due diligence in asking questions that they qualify and are able to claim these credits on there. And so typically some individuals are disallowed because of an error it could be due to fraud or reckless behavior. Most of the time they won't have to complete the 8862 if it was for math or clerical errors. So again, some individuals may have to add this 8862 if they're claiming some of these credits. So we want to talk about the Affordable Care, the premium tax. So under the Affordable Care Act, the federal government, state governments, insurers, employers, individuals share responsibility for improving the quality and availability of health insurance coverage in the U.S. So this is going back to that marketplace insurance on there. So there's still no penalty for individuals who do not have health insurance, but we have talked about if they have received health insurance through the marketplace, we will need to have that form 1095A on the tax return to reconcile their income with the subsidy amount that they have received. We've already talked about if their subsidy, if the income that they provided to the marketplace was less than the income provided on the tax return, there is an excess payment that they will have to pay. So their tax return income is greater than the income that they provided. They will have another taxes amount. So someone on the return had health insurance. So it doesn't mean the entire household has to have health insurance through the marketplace. It could be one individual. They could have had health insurance for just 1 month or 1 day. A 1095A will be needed to input on the tax return. If advance payments of the premium tax credit were made for coverage of the taxpayer or dependent or spouse, the taxpayer must complete Form 8962. That will have to be added to the tax return. So we've talked about the other taxes side, but there may be a refundable side. So this is the net premium tax credit. So the income is less than what was reported to the marketplace. So the advanced premium tax credit is less than what should have been received. So I've told the marketplace that, I would make $40,000 for the year, and something happened throughout the year. Maybe I got sick. I maybe lost my job, and so I actually only made $20,000. So my premiums were based on the 40, but when I do file my tax return, my income that I actually made is $20,000. So based on that $20,000, my premium, my subsidy should have been greater. And so TaxSlayer will factor in that difference. And so that additional subsidy that I should have received assistance with, it becomes a refundable credit on the tax return. So another refundable credit is the recovery rebate credit. So this kind of follows up with the tax year 2020. So eligible taxpayers who receive a smaller than expected income tax payment, that's that EIP, and we know it as the stimulus, may qualify to receive an additional amount when they file their 2021 federal income tax returns. So these economic impact payments, those were treated as an advance on there that eligible taxpayers can claim on their 2021 tax return. So typically in tax layer, when we start off with the basic information, we will see it pop up and it will ask about the third stimulus or the third impact payment that was received, the amount received. And we want to put in the full amount. The taxpayer will need to list the full amount that they received, even if those dependents are no longer going to be listed on the return. They would have to put in that entire amount, not just the amount that they themselves as a taxpayer. If it's a married filing joint, what is that joint amount received, as well as the amount received for any dependents that were listed. And this is just for the third stimulus payment only. So by listing this on the tax return, we do make sure that we let the taxpayers know. It will not reduce a taxpayer's refund or increase the amount they owe when they file the tax return. So this stimulus payment, it is not treated as income. It is not taxable. So we do not include it on the tax return. And for this third stimulus, it was for U.S. citizens and U.S. residents aliens that they would receive up to $1,400 per individual listed on the tax return. So that is up to $1,400 per individual because they did have income limits on there, so it would start to phase out. Individuals would need a valid social or a valid ATIN or ITIN number for this EIP. So a valid social or valid ATIN, which is an adoption number. But we're going to see mostly those individuals with a valid social to receive this. Individuals also should be on the lookout for their letter 6475. They should be receiving that in the mail and really need to bring that to the tax office so that we would know the full amount that they received for the third stimulus. So if they do not have that letter, we typically try to get them to look at their accounts and see what the amount was. So these amounts started going out, I believe, in March of 2021. Now, I will say with this recovery rebate credit, because it is a refundable credit, if there were other taxes amounts, it's going to reduce the amount due on a tax return. So I would give an example of a self-employed individual. They did not make any estimated tax payments, and they have tax due of $2,000. And for some reason, they did not receive that third stimulus of the $1,400. That stimulus, this recovery rebate credit, will reduce that other tax amount, that $2,000. So then they will now have an amount due of $600 on there. So this is the recovery rebate credit. There are only 3 stimulus payments. The first and second one were related to the 2020 tax return, and the third one is related to the 2021 federal tax return. So this is another credit that is coming back. It is the credit for sick leave. So there's a 2-part component to this one, and this is related to self-employed individuals. So they're allowed an income tax credit to offset their federal self-employment tax for any taxable year equal to their qualified sick leave equivalent amount. So you'll see that I have this qualified sick leave amount bolded because these bullet points and the amount pertains just to that. So this qualified sick leave equivalent amount, it is if they were under a federal, state, or local quarantine or like isolation order, They were advised by a healthcare provider to self-quarantine. They were experiencing symptoms, seeking or waiting the results of a diagnostics test, or obtaining immunization related to the COVID-19. So if they were not able to work, then for those days, they're able to take the lesser amount of the number of days they were not able to perform services times $511, or 100% of the average daily self-employment income. And so for this one, it is maybe related to the sick leave related to a family member. So this is they were caring for an individual that was subject to a federal, state, or local quarantine or isolation. Caring for a child if the child's school or place of care the child was at was closed, or the child care provider is unavailable due to COVID. They have to accompany an individual to obtain immunization, or caring for an individual who is recovering. So again, this would be the number of days, lesser number of days that they were not able to perform services times $200, or 67% of the average daily self-employment income. And you'll see this cannot exceed 10 days. And so once we just put the information into TaxSlayer, those number of days, we've already input their self-employment income. When we did the income section, TaxSlayer will then calculate this refundable credit for us. And so the last one for this, we then have the qualified family leave. And this one is just based upon caring for a child if the child's school or place of care of the child was closed, the child care provider of the child is unavailable due to COVID precautions. And again, this one is number of days times the $200, or 67% of the average daily self-employment income. So just a little more verbiage on here that you're able to go back and look in on page 40, in the 4012, page 810. It just tells us the number of days, up to the max number of days that can be used to calculate the family leave credit. And so they do actually have parts of the year broken down. So you can see January 1st through March 31st, it's up to 50 days. And then up to 60 days for April 1st to September the 3rd. April 1st to September the 30th. So again, TaxSlayer is very helpful with us, where it will break these dates, these time frames up for us, and we will just now have to put in the number of days that the self-employed individual would qualify for this credit, the number of days that they were out of work. And taxpayer will calculate that for us. So we are up to a poll question. And it says a taxpayer has interest income of $4,500. His earned income is only $7,000. He is single, has a valid Social Security number, and is not the qualifying child of anyone else. Does he qualify for the EIC? So launching this poll question, and it'll give you about a minute to answer. Okay, I am getting ready to close the poll question. Okay, and we had 85%. They said yes. And for those of you who said yes, you are correct. That amount was the investment income threshold. It's below his investment income is below the threshold limit, which is now set at $10,000. So we're going to go to our next poll question. It says Jewel and her daughter live with Jewel's brother Emmett all year. Jewel earned $20,000 and claims her daughter as a qualifying child for the EIC. Emmett is 25 years old and earned $8,500. Is Emmett able to claim the EIC for a taxpayer without a qualifying child? Okay, and you have about a minute as well there. Okay, I'm going to end this poll question. And we have a 64% saying yes. And if you said yes, you are correct. Emmett is able to claim the EIC. So Jewel's daughter is not the qualifying child of Emmett, but he can claim the EIC for a taxpayer without a qualifying child. So he will meet those requirements.